January 20th sees Donald Trump's second inauguration as he steps back into the White House, and markets are likely to be highly sensitive to any initial announcements, bearing in mind there's a number of different question marks we need to see answered as we go forward. And markets across the board have been quite hesitant because we don't necessarily know exactly what he's going to do. And we also don't know what the implications would be from those actions. Of course, there's a perception that he's going to potentially drive up inflation. We don't necessarily know that will happen. And so that recent sort of lower than expected inflation gauge provided a significant relief rally for markets. But there's still questions that need answering, and there's a number of things that we should be watching out for as we head into this inauguration and look out for this initial period under Donald Trump. So let's look into those and try to gauge exactly what the trajectory could be for US stocks, different sectors, the US dollar, the likes of oil, and the likes of gold. So we can see that essentially we're going to be talking about a whole host of different factors, and it's up to Donald Trump really as to how quickly he addresses some of these things. It's not necessarily a given that he will address them immediately, but certainly there's a feeling that people really do like to focus on, what have you achieved in your first 100 days? So this first period of time is going to be key. And certainly markets are growing fearful at the moment. And we've seen that with the surge in terms of borrowing costs, i.e. the likes of the 10-year yield, the 30-year yield, the 2-year yield, and the like. Those borrowing costs have been moving towards the upside in the anticipation of a number of different things, right? Number one could be the anticipation of higher inflation. If he's going to be enacting tariffs, if he's going to be pushing for greater stimulus and greater spending within the US economy, then you're talking about a potential reflation move that sort of hinders the outlook for rate cuts from the Federal Reserve. So what will he do on the sort of stimulus side of things? And is that perceived to be inflationary in nature? Now, certainly one of the things that we heard about not so long ago was this idea that if a company invests $1 billion or more in the US economy, then they'll essentially get fast track approval for, maybe environmental concerns and the like. And things like that are going to be really interesting because it means that they're trying to bring increased investment, but they're not necessarily spending money to do that. It's not government spending aligned. So it wouldn't necessarily be inflationary per se in the same way as the government suddenly deciding that they're going to, wheel out a multi-billion-dollar spending plan on something. So coming out with those kind of strategies, like it or lump it, whether it comes to, the sort of environmental side of it, but ultimately you're talking about the potential ability to look at inflation as something that is a key concern for many of these. And certainly we have been hearing recently about the possibility that Donald Trump is going to ramp up the tariffs at 2% per month. And that essentially means that it sort of kickstarts conversations with other countries to be able to strike a deal and get it done sooner rather than later. Again, that's the kind of thing that points towards the possibility that we don't necessarily immediately see a ramp up in terms of inflation. And instead, it's a case of trying to use that to force the hand of their trading partners to get a better trade deal and wanting to have that done sooner rather than later. That, again, is good, quite frankly, and markets took that as a positive at the time. There's still significant concerns about inflation, and there will be, and we're going to be following it really closely as we go forward. But certainly when we're looking at, say, the FX markets, some of these key currencies are like the Australian dollars, the Chinese yuan, the Mexican peso. Those currencies are going to be really keenly watched as we see exactly how the tariffs shape up going forward. Tax and regulations are going to be really key. Certainly, there's certain areas that think they'll benefit from it. The financials have already really flown out the blocks when it comes to the beginning of earnings season, and there's an expectation they'll continue to do well. We'll look at the sector performance under Donald Trump in his previous tenure as president, and that can sort of give us an idea of what could do well. But certainly I think the banks have always done well, and looks like they're probably going to continue to do so. Also, when it comes to defense spending, but also foreign policy, he's already said that he's going to speak to Putin pretty early. And certainly with the fact that there's a deal on the line, looks like it could be enacted on Sunday for a ceasefire in Gaza. Do we see a ceasefire there? And we see a ceasefire with Russia and Ukraine. If that were to happen, that could have a double whammy effect of easier transport through sort of Middle East when it comes to like the Straits of Hormuz and places like that because of the ceasefire with Gaza potentially. And then at the same time, you have the possibility of easier gas flows, easier trade within Europe and Russia. You know, we don't necessarily know exactly how easy it's going to go back to that place that it was previously, but certainly that's something that we'll be watching very closely as we go forward. So let's just jump into a handful of these different charts that I've got for you guys that highlight a number of different things. So first and foremost, this is the goods trade balance. Bearing in mind, I've got goods trade balance, and that's key here, right? The tariffs are going to be on goods, not services. And key to it, certainly for someone like myself that's in the UK, you can see the red line on the top is the UK. So the UK is in deficit with the US, which means it could be in a relatively decent position to strike a trade deal, and it doesn't necessarily put it in a position to be hurt too much by tariffs coming out of the US. On the flip side, you've got some of these other countries. Of course, China has always been at the forefront of the mindset when it comes to enacting tariffs, and you can see exactly why. Absolutely massive deficit with China, but you've seen that growing deficit with the Eurozone as a whole. And so, you know, the likes of the euro will likely see significant volatility. Also, some of those big manufacturing countries, the likes of Germany, of course, have already been struggling, but they will really likely feel the pressure from Donald Trump, despite the fact that they are allies, and he has certainly pointed in that direction. Mexico, again, that deficit has been growing. So these are the kind of countries where you'll be following the discussions around tariffs very closely to see whether it's better or worse than expectations, and if there's any trade deal. And certainly, if it's worse than expectations, you'd expect to see suffering on the side of, say, the likes of the euro or the Mexican peso or like. If it's better than expectations, say that 2% per month, and they start to strike a deal, then it's a possibility that we actually see these currencies fare relatively well. Now, like I said, inflation has been key. Inflation will be key. There's a perception that Donald Trump is inflationary by nature when it comes to his policies, when it comes to tariffs and the like. And so let's just look at exactly where things are following the CPI release, because what we saw was a stronger reading in terms of headline number, but lower in terms of the core CPI figure. That's in sort of orangey, yellowy color there, and you can see below that we've also got the sort of reddy orange line, which is the core PCE figure. Nonetheless, within this chart, I've included a number of interesting things, including the shelter component, which is a third of CPI as a whole. And you can see that continues to move towards a downside. That should produce downwards pressure on inflation going forward. So that is good news. We've also seen continuation down of the downside for services as a whole, excluding shelter. That's key because we recently saw the ISM services PMI, which came out with a sharp uptick when it came to the prices paid element, and really did provide significant concerns. Well, at the moment, services are inflation continues to remain sort of in a decent position, quite frankly, and those fears around a potential resurgence in terms of services inflation isn't quite there at the moment. In terms of the headline inflation, though, you can see that the month-on-month figures in the middle here, in this middle section, continue to go up and up and up. It's a 0.4 over the last one. And so whilst we can look at the, say, last 8-month annualized figure and say that, okay, once the April figure is stripped out, once we get to that point, we'll essentially be at 2.15, so near enough at target. It's worthwhile noting that the May and June figures were the sort of key figures that really underpin this, and they're making up for the figures we've seen more recently. So the current trajectory is moving upwards when it comes to month-to-month inflation, and so you would see that on, say, a 3-month annualized, that it continues to rise. And the fact that it's happening with the headline inflation really highlights the importance of energy at the moment, and Donald Trump's policies towards energy will be absolutely key. He talks about, you know, drill baby drill, but that's the key, right? Are we going to just see rampant production in the US. And if that happens, then that could potentially put a lid on inflation. But certainly one way that his policies align with disinflation comes in the energy space. So it's going to be key for him to try and do exactly that, try to ramp up US production to the point where it drives down prices, and that can help mitigate some of the inflationary effects that we're seeing at the moment, particularly within headline inflation. Now, in terms of core inflation, what we've seen is significant sort of blue bars in the middle you can see there, which are the core CPI figures. It came down a bit this time around, and that comes off the back of a pretty low 0.115 monthly core PCE figure. Both of these are above target, 2.8 and 3.2 when it comes to the core CPI, core PCE. But, more recently, they have been coming down a bit, and certainly services inflation does appear to be cooling a little bit. And certainly the impact of that shelter component should hopefully also play a key role in driving down core CPI in particular. But certainly, if we're looking at, say, 7-month annualized, core PCE 2.2, the CPI sort of roughly 2.8. So, they're in the twos. They're not necessarily on the pathway to 2% exactly. No, but in terms of monetary policy, I don't necessarily think that they're going to be like, oh, we're only going to cut rates at 2, because we can see exactly that right now because they're cutting rates. So in terms of the US dollar, I find this particularly interesting. This is the trajectory of the US dollar from the last time that we saw Trump take the White House, and then this time, right? So we see this initial pop, and a lot of the time that comes in line with the fear of what might happen, right, rather than the reality of it. And the reality might provide the basis for US dollar weakness. And why would US dollar weakness come? Well, we would need to see a lid on inflation in particular, and inflation expectations. And that coming alongside economic strength and stock market strength and the like drives a deterioration in that haven demand, but also the relative expectation for rates and for yields between the likes of the US and, say, the EU or the Eurozone. So then once that shifts, then that turns things around. At the moment, there's a lot of fear. There's a fear of inflation. There's a fear of what Donald Trump might do. And we don't necessarily know what he's going to do or whether it's going to be inflationary. He could come out with an announcement, markets react negatively because they perceive it to be inflationary, but it's not. And certainly that's notable within the tariff space, because we've seen him enact tariffs in the past. They weren't particularly inflationary by nature. We didn't see a protracted upside move in terms of goods inflation. And at the same time, goods inflation is pretty much non-existent right now. It's all about services inflation. And as long as we keep a lid on services inflation, then we're in a decent position. But nonetheless, right now, a lot of it's down to sentiment, and sentiment points towards higher inflation. And that's why we're seeing this strength for the US dollar. So the announcements that Donald Trump comes out with, and his ability to portray a willingness to constantly consider inflation and not want to drive inflation higher, that's going to be really key for markets. In terms of the FX space, like we were talking about, some of the key currencies that are going to be impacted when it comes to tariffs will be related to those that are big exporters. So Australia, New Zealand, Canada, of course, but then we're talking about Mexico, China. And so this is really key going forward as to understanding exactly which of the currencies are likely to be impacted. When it comes to the sectors within the US, we can see here in terms of sector valuations, it's the tech sector that is really highly valued, and that's understandable because of an expectation of really significant growth going forward. I would draw your eyes towards the sort of bottom left of this section if you're looking at the sort of lower valued names, and certainly financials looks particularly interesting down there in terms of its valuations, and financials I think are going to be a strong one to be following out for. So Mag 7 remains key as we go forward. We can see here that the domination of some of these Mag 7 names in particular since the sort of AI inauguration. It feels like when that ChatGPT 4 launched, that's when it really started to ramp up as a major topic within markets. And we can see, of course, NVIDIA really outperforming. Meta also doing particularly well. But at the bottom of this with the grey line, that's the S&P 500. So big tech, will we continue to see them outperform? That remains to be seen, and hopefully they will at least provide the basis for continued strength as we go forward for the US markets, as we see Donald Trump potentially enacting policies that realign growth towards the rest of the economy, and so providing a regulatory framework and tax benefits to companies that hire and create jobs in the US should potentially provide the basis for strength for other parts of the economy, and not necessarily just relying on Mag 7. In terms of looking back to Donald Trump's first period at the White House, of course, the first 3 years are key here because then we start getting into COVID territory. But you can see in terms of the regular strength and the reliable strength here, it comes from financials. You can see information technology, of course, big tech, always at the forefront, really, with that light blue line. But I would say that those financials look really healthy. It's something that I pointed out prior to the election, and then we did a breakdown also after the election. But financials, big area of strength, and we've just seen earnings from 4 out of the 5 biggest banks over in the US, and they're all doing really well. They're in a position where they see high rates, which means high margins. They're seeing an environment where people want to start to invest once again. People feel more there's going to be beneficial regulation coming in their way, and there's going to be increased deal making. In terms of the market performance, we've seen such strength since the election that means that trading volumes have also been elevated for these banks. So really the banks and the financials are in a really interesting position as things stand. But you can see here there's other sectors for you to consider when it comes down to who might win and who might lose under Trump. In terms of the S&P 500 as a whole, we can see we're coming off the back of 2 years where we've seen gains of over 20%. Now, it's normal that when you see a couple of years of 20% growth, you don't necessarily see it again, right? It's not that normal to see 3 years in a row of 20% growth and above. So there's some question marks about whether the lofty valuations within markets at the moment mean that we're going to see something a little bit calmer this year. Now, a lot of it's going to come down to the expectation from the Federal Reserve. A lot of it's going to come down to what happens in terms of inflation. But certainly, this year is expected to be a strong year if you're looking at the possibility of Trump to come in and enact policies that are good for markets. But we need to see him do exactly that. And there's going to be close eye really on what Donald Trump does when he comes into power, because people are aware of this, right? Highly valued markets at the moment when it comes to, say, price to earnings ratios, in particular for some of those big tech names. And so as you see a slowdown in growth on big tech, are we going to see a pickup in terms of the growth rates for elsewhere within the market? In terms of some of the charts to watch, let's just breeze through a handful of them. First and foremost, this is the chart for essentially borrowing costs over in the US are aligned with bond yield. So you can see here 10-year yield, the 20-year yield, sorry, the 30-year yield, the 5-year yield have all been popping of late, but starting to roll over a bit following that US CPI report. But certainly this is going to be key, right? Because there's a perception that Donald Trump is going to ramp up borrowing, and with higher borrowing, then the fiscal position of the US government deteriorates further. And so we're seeing higher yields as well. That means that we're going to see higher borrowing costs and more borrowing, and it just means a greater amount of debt. And that's not a great position to be in. So certainly this is going to be a key chart to be watching as we go forward. And certainly a deterioration of this is beneficial for markets. For one reason, it means that people don't necessarily think they can get a risk-free return elsewhere by just investing in bonds. And on the other side, you're looking at a potential for government to spend less on borrowing and more on the economy, which of course is a good thing. In terms of the S&P 500, the long-term trajectory is always up. And so when you do see downside moves over a short period of time, always be aware of the fact that this is a really reliable market. You can see that, we see protracted moves within things like economic crashes or pandemics. But that's not the norm. The norm is that we go up, and you can see the most recent pullback has taken us down into a really deep retracement into the 76.4 fib. And now we're heading higher once again. Certainly, if we're looking for the bulls to really gain greater confidence. 60.18, that level, if we break through it, it's going to give us greater confidence that the bulls are in charge. Key to much of this is going to be keeping a lid on energy prices, and certainly we've been sort of sideways for much of the past year and a bit. I say sideways, but it's more a case of just like we've got much of the price action taking place within this sort of range. We did pop up in sort of the back end of 2023, but certainly you're talking sort of 65 to 85, that kind of area. Well, we're rallying up to the $80 mark, and we really don't want to see a move back towards that $100 threshold for energy prices, because it's going to drive up that headline inflation. And of course, whilst you could say, headline inflation is impacted by things like food prices and energy prices that the Fed can't control, well, underlying energy price gains will ultimately then lead to inflation elsewhere, right? So businesses then start to put up their prices because the cost of transporting their goods rate rises. Employees start demanding more because they're paying more for their cost of living. So we need to keep a lid on energy prices, and that's why it's going to be really key to see Donald Trump's policy when it comes to the energy sector. At the moment, moving sharply towards the upside, but I would say look out for this area of resistance, your sort of 84s to 85s, that kind of area. If we keep a lid on it from there and we see Donald Trump enacting policies that make us believe we're going to see a strong move towards the upside in terms of output from US producers, then hopefully that does enough to keep a lid on the gains that we're seeing at the moment. Because of course, we're expected to see higher growth this year. And higher growth, higher economic activity comes hand in hand with higher demand when it comes to crude goods. And then I wanted to highlight what's happening in terms of gold. And certainly gold has been strengthening at the moment. That comes despite the fact that we've been seeing strength in terms of the 10-year. If we're looking at the 10-year as a sort of proxy for inflation expectations, ordinarily what we would expect to see is when we see this rolling over. So when we're seeing deterioration in terms of inflation expectations, that's when we see gold really outperforming. And that's what we did see in the past here, right? It was when this started to roll over that we finally saw that breakout and a really strong move higher for gold. Well, we've been seeing this resurgence taking place here for the 10-year, and gold's been holding up very well. So ordinarily gold should be heading lower at that period. But the fact that it's held up so well during this period, for me, points towards a strong possibility that we see gold really outperforming in a meaningful manner when we see inflation expectations really rolling over. We're not seeing it at the moment in a too much of a meaningful manner, but you can see that when it came to that US CPI release, gold saw a nice pop. And that highlights the fact that lower inflation, more rate cuts, that's good news when it comes to precious metals. Towards the upside, 27.21, the key resistance level that's capped this move previously from November 2024 and December 2024. And if we see a move through that level, then you're going to be looking up at this prior peak of 27.90. But certainly for me, I think this market's been holding up really well within an environment where essentially you're looking at something that shouldn't necessarily be doing all that well, quite frankly. When it comes to the US dollar, we can see that the long-term trajectory looks very bullish, and we've seen this breakout following sort of pullback, retracement, consolidation, and we've been breaking higher from here. Of course, we got that chart that I showed you previously that highlighted that under Donald Trump, he initially had this pop in terms of the US dollar, and then it started to roll over. But really, it's going to come down to whether people within the markets perceive Donald Trump's initial announcements to be inflationary by nature or not. And so I would just follow this on an intraday basis. The 4-hour chart looks like a good one at the moment. So just look out for these pullbacks to be likely retracements, and a breakdown through the price swing low needed to negate that view. So that means at the moment, unless we break the 107.75, then this near-term pullback likely represents another buying opportunity. Markets are feeling a little bit better with the whole, US CPI release. But I would say we're not necessarily out the woods, and certainly we need to see exactly what Donald Trump's going to do and whether that is going to quell inflation or instigate a second move towards the upside. And finally, I just wanted to bring up the chart for the US dollar against the Chinese yuan. And essentially, you're looking at a similar kind of move, but you're looking at something that is really likely to be heavily influenced by those initial announcements, certainly keeping an eye out for tariff talk in particular. And it's notable that, if the Chinese have to deal with a huge amount of tariffs from the US, well, how could they make their products more competitive internationally in the face of big tariffs? Well, they can devalue their currency. So a weaker yuan actually counteracts some of those tariffs, and it points towards, especially in an environment where we're seeing dollar strength, if we see high tariffs placed on Chinese goods, then you're looking for further upside for this pair, because global inflation, that's affecting the likes of the US and the Federal Reserve in particular. And then when it comes to China, well, they'll be quite happy to essentially adjust their currency to the point where it sort of devalues some of those tariffs enacted by Donald Trump. I hope this has been useful. Like I said, the inauguration takes place on the 20th, and we're going to be watching very closely in the weeks that follow to see exactly what the big announcements are from Donald Trump and his team.